And welcome everybody to another episode of Smart Money Circle. I'm your host, Adam Sarhan. With me today is Wang, CFA Vice President at Global Real Estate Securities with about 100 million AUM. Jimmy, thank you so much for coming on the show.
Sure, Adam. Thanks for having me.
So, Jimmy, I always like to begin by asking, can you tell us your story and how you got involved in the business?
Yeah, I'd love to. I think everyone has a unique story. Mine's not so different, but also a little bit of, something unique about me. I'm an immigrant, born in Shanghai in the slums, no indoor plumbing, all that good stuff. But came to America in the early 90s as a young child. I think always had a knack for math and, things finance related, numbers related. Graduated high school in '04 when the going was good for finance, right? Everyone wanted to do banking, Gordon Gekko, Wall Street, all that good stuff. Had the fortunate opportunity of graduating in '08 during the great financial crisis, so to speak. But I survived, and 12 years later, here we are. But really, just had a chance to kind of hone my expertise at Wharton undergrad. Did finance there, and our industry has really changed a long way. So I'm happy to talk about that later. But I'm your classical, numbers guy. I like to schmooze. I'm pretty extroverted, and that's how I got into the business.
Nice. And tell us a little about your investment strategy.
Sure. I work for a French-based real estate investment manager, and what we do is we have a few different mandates, but we primarily focus on long-only benchmark strategies for REITs. We have a long-short hedge fund that maintains about 50% net exposure. So it gives us some real estate exposure, but it's also maybe a best ideas kind of portfolio. And we have a few other more bespoke, custom portfolios that tailor to our clients' investment needs. We have a Sharia portfolio that handles Islamic compliance. It's more Islamic compliance related. We have a counterparty that does a lot of the screening. We have a high yield product, which is also good for a lot of retail clients that want current income. And, happy to talk through each of them, but maybe we can start off on one in particular.
Sure. I mean, real estate's your focus, so we can focus on real estate. If you can just help explain to the audience for an introductory level or more rudimentary explanation of a REIT and what it is, why people invest in it, so on and so forth.
Yeah, happy to. So a real estate investment trust is, technically it's a tax kind of designation, but it allows a corporation to prevent or to bypass double taxation as long as they pay out the majority of their earnings in the form of dividends. So it's great for shareholders that like to get some current income. We have a lot of retirees. We have a lot of, investors of all ages that want steady income growth and dividends on their investments. It also, because of the depreciation that exists within real estate, it allows these companies to aggregate, quite sizable portfolios and operate them in a very tax efficient, operationally efficient manner, and the shareholders really benefit. They get best in class management teams that own, develop, manage real estate with a very, very efficient G&A profile. So the average investor, instead of having to buy, an office building for hundreds of millions of dollars, we obviously can't do that. We get to get exposure to some of the highest quality real estate.
Interesting. So as a special focus in REITs, how do you differentiate yourself from other people that focus in REITs as well?
That's a great question. At La Française Forum Securities, we typically have a longer-term focus. We like to run our portfolio with a low asset turnover than a lot of the major, larger market, players that tend to trade every month to 3 months that work around these benchmarks. I think, we have a well-tested, back-tested strategy where we look at a combination of things, discounted cash flows, net asset value, which is an interesting thing in real estate, right? We know that hard real estate is worth something. Sometimes it's a combination of how much income you can generate from it. Sometimes it's dependent on how well you can finance a particular asset. We think about our single family homes and how low interest rates are and how much homes are worth based on how much debt people can put on them. So it's a very interesting asset class, but we do a very deep fundamental approach to our real estate holdings. And then, on the short side, same thing, for the strategies where we're betting against companies because we think they're overvalued or we think that there's a mispricing in the market, we'll kind of lay out our thesis for why we think companies trade in a certain way. Also valuation is not always a catalyst, right? Expensive companies can stay very expensive. But we look for catalysts. We look for, we'll do our channel checks to see, if management teams have added value through the cycle. I think you'll find for most of these companies, the best, the highest valued companies also have the best run management teams that have done well by their shareholders through the cycles. And investors remember that.
So, Jimmy, let me ask you two questions here because you brought up two good points. One, how do you determine value? I know value is like beauty. It's in the eye of the beholder. Longtime listeners of the show or know me, and that's what I like to say. So that's one question I like to ask. And the second question is, how do you determine if management is quote unquote good, that they've been able to handle themselves or navigate multiple cycles, or are there other criteria that you look for with respect to numbers? Since you're a numbers guy, you do look at certain, fundamental metrics as far as how they manage their money, their ROE, ROI, whatever the case may be, or they're, if you can speak to that a little bit or elaborate, we'd appreciate it.
Sure. Warren Buffett has that famous quote that says that, in the near term, the markets are a voting machine. If there are more buyers than sellers, then stocks go up. And during the great financial crisis or during kind of an acute crisis like we have now with the coronavirus, on any given day, if there are more sellers than buyers, companies can go down way below their intrinsic value, let's say, right? But when I think about value, particularly as it pertains to real estate, I want to see the income stream, and when I think about value for companies, a very unique dynamic that REITs have is that if you think about a REIT having, let's say, 10 or 100 assets, a bottoms-up approach would say that the net asset value of the company should be the totality of all the different assets that it owns, right? And presumably, there is a transactional value that's been recorded in the private market that gives a comparable to where this portfolio could sell if the company were to go away. Because of the tax status of REITs, where they have to disperse their earnings to their shareholders in the form of dividends, when companies want to grow, they have to continually come back to their largest equity shareholders. So, whether they want to develop a new asset, whether they want to get into a new market, over time, these REITs have long-standing relationships with their equity partners, and that forces a type of capital allocation prudence that other companies that can retain their earnings might be able to obscure, right, in terms of financial details. So presumably when a company trades at a premium to its underlying net asset value, the sum of its assets, the smart thing to do over time is to issue equity at a premium, then to take, let's say, 110 cents on the dollar because they're trading at a premium, and then they have the opportunity to go out and buy new buildings to collect new streams of income. Conversely, if the company is undervalued, if they're trading at a discount to their net asset value, theoretically, they can sell their assets in the market. If the company is trading at 80 cents on the dollar, they can sell for 100 pennies on the dollar, take that cash back, and either buy back stock or find out other ways to reduce their discount over time. So I think that's some of the more mathematical academic side. Now you say, over the long term, how do we know these companies are doing right by their shareholders, right?
Right.
Particularly coming out of the GFC, we saw which companies levered up on cheap debt. We saw which companies blew away a decade's worth of sweat equity because of that, because of the downturn. And we saw when you had the rising tide, it lifted all the boats, and then now, everyone's naked because the water's receded. So when you look at the best companies, they have a light G&A load. They are responsive to their largest shareholders. They tend to be internally managed with great disclosure. You'll also see in real estate often, because of these asset management platforms, is that some REITs can be externally managed where the REIT management team has an incentive to grow their asset base because they are collecting a fee revenue, right? And so the shareholders don't benefit from kind of a non-nuanced collection of assets that don't really have a rhyme or a meaning, that become also harder to manage. So the best REITs we've seen, especially in the U.S., tend to be local sharpshooters. They know their markets very well. They tend to concentrate in one specific asset class. So they have a wealth of knowledge. They have all the broker-vendor relationships, and they can really add value within that asset class, I think, in a very specialized kind of way that others can't.
Understood. So what's a good way of explaining or illustrating for the audience ways that people can add value?
Sure. Well, firstly, I think, when I think about REITs as being landlords, developers, and also asset managers, as a landlord, we have property level net operating income. So what we can see is that the REITs that are located in better markets with better assets can outcompete REITs that have inferior assets and in poor markets, or even their peers in those same markets will see net operating income margins. So between REITs, there might be differences in margins. Some of that could be company scale, but some of that could be operating efficiency, right? That's something that a fundamental analyst will, dive deep down into the numbers and figure that out. I think also, when I think about real estate, it's not as static. It's not as dynamic as tech. Tech in the 1980s versus tech in 2020 is completely different. But people who've been around in real estate have seen different markets develop, different cycles ebb and flow, crest and trough. They can see larger term demographic shifts within submarkets. And I think what you'll see is the best REITs started out with smaller portfolios. They were very timely and astute about buying land, buying renovation projects, and upgrading their portfolios over time. And now you see, especially in the U.S., the REITs own trophy assets. They are some of the smartest guys. A lot of the guys from private equity want to work at SL Green, Boston Properties, some of these large cap REITs that are really some of the best at what they do.
Interesting. So next, I guess it's a good segue. How do you handle risk?
Yeah.
And what mistakes do you see people make with respect to risk management?
Well, risk comes in many forms, right? There's financial risk, there's operational risk. I think first, when you think about financial risk, all real estate has a leverage component. As an individual, we put mortgages on our homes. And if we have good credit and we can borrow at a low rate, imagine what a multi-billion-dollar company can borrow at, right? They can borrow at practically zero in today's environment. And I would, argue from an equity shareholder's perspective that some leverage is prudent. It helps me maximize my return on equity. And I have tax advantages from using debt, especially when it's low cost, and it allows me to expand my asset base. So, when we look at financial risk, we have secured borrowing, unsecured borrowing. All these terms are somewhat specific to real estate, but I want to see that, it both at the trough of the economic cycle and at the peak, that I can cover my interest, that I have flexibility with my creditors in case, you look at some of the lower quality malls today, they're really struggling, right? Some of the operational risk where they didn't get ahead of the trends in fashion, in apparel, in online e-commerce, and they were stuck with these inferior bricks and mortar locations. Some of that is operational. They could have done more to juice up their assets, to drive more traffic, but some of that is operational. Financial. You have a lot of lenders now that don't want to lend to lower productivity malls. You have a lot of strip centers that were overdeveloped in '07, '08. These, outdoor open air lifestyle centers that, were the people would congregate in these town centers during the best of times. But in the recession, no one wants to go to Pier 1 anymore. No one wants to go to some of these retailers are really struggling, and they relied on that traffic. So there's, when you have to finance that asset and you're losing traffic, you're losing business. There are two types of risk that kind of come out at the same time, unfortunately, even though we like to think of them as separate.
So that's a really good answer. I guess you view risk in multiple levels, not just from a portfolio standpoint, but from also a operational standpoint and so on and so forth.
I mean, that's absolutely correct, right? So, not just at the individual security level, but then when I put together the portfolio, I'm analyzing all my risk factors weighted by my, investment positions. But we've seen clearly just in this past month in prior downturns that, when there's a severe downturn, whether it's macro driven or it's fundamentally driven, that there's a very high correlations across all asset classes.
Right.
So some of those things that we can't really control for, we all become historians. We have to kind of revert to in '08, '09, what was the playbook, right? We always tend to anchor to different events, and that's a little tricky because we don't have a strong anchor today. But some of those factors still hold true.
No, that's a really good point. So since you mentioned the current environment, we happen to be in the middle of the coronavirus or COVID-19, however you want to word it, situation, lockdown. And how does that impact? I mean, I'm not going to ask you how that impacts the business. That's obvious. But how does that impact valuations on a current basis and a forward basis? I know this is a one-off. It's not a normal situation. And it all depends on how we get out of this. Is it a U-shaped recovery, a V-shaped, L-shaped? I understand that. But from a valuation standpoint, how do you value these things differently based on external events, whether it be '08 financial crisis, a health crisis, whatever the case may be? Or is it just, hey, time and true, this is how we do it, so be it? Or how do you guys adjust in those situations?
Yeah, that's a great question. And, there's a push and a pull in each different way. So I think I'll try to address it, in the best way that I can. I think first, when you look at, in the context of the COVID-19 crisis, the health crisis, and our response to it, the Fed has dropped interest rates down to basically zero. We've bought back a lot of treasuries and other bond instruments to stabilize the financial markets. And, so in this crisis, the first thing that really goes away is price discovery. We've seen real estate transaction volumes drop. We've seen the capital markets seize momentarily. I think we're doing the best we can to keep it open, but the bid-ask spread widens, particularly for corporate credit.
Right.
I think a lot of your listeners will, know and have heard about the stress in a high yield market and the fact that a lot of the triple B companies had even more leverage than the double B companies. So much of it was investor driven. And these REITs, particularly to maximize their return on equity, utilized a healthy amount of leverage, but certainly some leverage. And so in this case now, a lot of people are finding that they are unable to come to market, at the terms that they want. They're unable to sell assets at the same prices that they paid for them or that they had expected to sell maybe 12 months ago. Now, again, I think if you own a Class A multifamily building in Manhattan, I don't think the price has gone down by 36%. If you were to look at the U.S. REITs that own multifamily buildings, they're down 30, 40% this year. I think the value clearly has not been destroyed to that factor. But I think the uncertainty about our economic situation, mathematically raises the discount rate, and there's kind of a negative sentiment spillover to these, buildings and these real estate companies. Now, again, when we turn to Europe and Asia, we've seen that dropping interest rates to zero can sometimes increase the bid for real estate.
Right.
when there's a real yield to be collected for the equity investor, when cap rates, if you think about cap rates are, income multiples. So the lower I can finance an asset, the cheaper the debt I can put, the more I can bid up for the asset. You can say that there is almost an inverse correlation between the interest rate environment and the value of real estate. When you're in a 0% real estate environment, it's not surprising to see real estate valued at 30 or even 40 times earnings. Um, as crazy as that number sounds at first, it's very, very much a function of the capital market environment. So there's a little bit of both. In the near term, I think you could see some income deterioration. You hear about people withholding rent. A lot of retailers have trouble paying rent. A lot of individuals are thinking about the same thing. But over the long term, well-located, real estate is not going anywhere.
Understood. No, that makes a good point. It makes a value argument too. If you can buy it as a distressed asset or even deeply undervalued asset, when it does turn around, you can clean up.
Completely. Yeah.
Understood. So, next question I have for you, Jimmy, is what are some timeless lessons you've learned along the way?
That's a great one. I've been on the buy side for about 10, 11 years now, and unfortunately, I entered a time at the end of 2009 where we really saw companies, the mistakes they made on their balance sheets, and just from the last cycle, we've seen over this last decade who's learned their lesson, who's repeated a lot of those same mistakes. Who's done better by shareholders, and who's kind of floated along. So I think as an investor is that it's impossible to call the top or the bottom of the market. We've had several hiccups along the way since 2009. We had a hiccup in 11. We had the taper tantrum in 2013 when, I think Bernanke and Yellen were looking at interest rate hikes. We had currency devaluation crises in Asia in 15 and 16, and now here we are. Right? We had to deal with the unpredictability of Trump. We've had several different macro events along the way, and multiples have continued to climb, earnings have continued to climb, and so certainly I think calling the top and calling the bottom, we all try to do it, but that's nearly impossible. So I think it's best to stay to our investment process, and we can talk about that a little bit later. But I think timing the market one is the most unpredictable of them all.
Interesting. So when you see things get devalued, if the timeless lesson is just stay the course, do you adjust your strategies based on, and you mentioned the word cycle several times in the interview today,
Mm-hmm.
Do you adjust your investment process based on where we are in the cycle? Or do you just say, hey, let's stay the course, and when it goes down, if we can do dollar cost averaging, or how do you
Right.
exactly handle that situation?
That's a great question. And within real estate, there are several different asset classes that have different levels of economic sensitivity. When we think about hotel real estate, it's very, very pro-cyclical, right? We've seen what this economic shutdown has done to the lodging companies and the air travel companies, any company that's economically sensitive. So I think, there are some economically sensitive strategies where it's best to load up at the beginning of the cycle, no matter how painful the data sounds, and then especially now later in the cycle, when valuation is no longer the primary focus, it feels hard to sometimes stick, in these more expensive companies, but they could be more thematically resilient in a downturn. So, for example, one of the great asset classes that we invest in is manufactured homes. On the outside, it's, you think, oh, are these trailer parks, right? Are they low income? Are there credit issues? But this is a lifestyle driven, it's a demographically driven segment of the market that loves RVs, loves the mobility, loves the freedom to move around. There's very low capital expenditures. The tenants are very, very sticky. And it's a business that's experienced a secular boom. So no matter what the valuations look like today, we believe that there's, 5, 10, 15 more years, there's just an extended runway. And I think another sector that I can point out to is the industrial sector. In the past, real estate investors have always looked at these large million square foot boxes with some skepticism. They're easy to build. It takes about 9 months to a year. There's hardly any investment inside the building to the landlord's cost. So they are frequently prone to oversupply. When the economy is hot and the land values are getting more pricey, everyone wants to build across the street, right? But today, with the e-com revolution, we're really seeing that for the tenants that reside in these industrial warehouses, the rent is such a small, percentage of their overall cost structure, maybe 3 to 5%. The majority is in, labor, transportation, gas, and all that stuff. They're happy to pay more to be in the best real estate. So, versus prior cycles, we are seeing an extended runway for some of these real estate asset classes that, benefit from kind of a lack of cyclicality, so to speak.
Yeah, that makes sense.
Today. So again, it really depends on the subsector, but absolutely our strategy changes depending on where we think we are in the economic cycle.
Gotcha. No, that makes perfect sense. Well, the next question: how do you, what are some timeless mistakes you've seen people make, and how do you avoid them?
So maybe I'll share a few, from personal experience, particularly as an asset manager. Not so much in timing the cycle, but what I see a lot of portfolio managers do is when it's time to buy and sell, right? When it's time to buy and sell, I think there's a natural inclination to want to sell a winner, to take profits, and to reinvest it into a loser in the hopes that there's mean reversion, that there's a potential to, so to speak, double up. You're selling a winner, you're selling high, and then you're buying low, and maybe you're riding a second wave. But that over time tends to really, mess up some of the risk management tools. And again, when we've seen that valuation alone is not a catalyst for outperformance, we find typically that, in my experience and with other managers, that we can quickly get into a position where we have a laggard portfolio that is, chasing some upside that doesn't exist in the current market context. And then let's say there's a downturn and suddenly we find ourselves with companies we thought we were cheap that now we don't want to own any of the names, right? So one of the things I've learned from that is, if we sell winners, we want to buy winners. If we sell losers, we want to buy losers. That helps me, adjust my beta in a proper fashion. It helps me think about the other factors at play.
Right.
We talked about the correlated performance of all equities. And, it's not the most sexy thing to do, but clearly, if I'm managing 30, 40, 50 names, even in a core satellite position, I'll have large cap core companies that I love and I want to hold over a business cycle. But the names that come in and come out of the portfolio that I'm trying to make more opportunistic investments in, I have to be very careful about what are the risks I'm taking and what are the risks that I'm actually taking that I don't know about.
Right. So it's looking at risks, both the known risks and the unknown risks. Is that a good way to sum it up?
Sure. And sometimes the reason why we pay a higher multiple for certain companies is because we just have better visibility, right? We either believe in the management team more. For example, again, this is a small real estate space, a CEO that does very well by his shareholders, that gets taken private at a massive premium, 1 or 2 cycles ago. If they want to come back to the equity market, I think they have a lot of goodwill. So let's say they want to raise a new fund and people know that this CEO is a winner, that fund is going to get the benefit of the doubt.
Right.
Whether it's warranted or unwarranted, we tend to have a pretty good memory with these things, and so we've seen who the good capital allocators are, and we can kind of make some of these qualitative determinations.
And then what are some examples of unknown risks for an investor to look at when they invest in REITs or anywhere?
Yeah, we've seen them. I think risks that are unanticipated. There's been a few cases of accounting fraud,
right?
In every industry, and real estate has had its share of that. I think there are other cases, we've particularly in new sectors. So I think something interesting about real estate is, for the longest time, when people ask about real estate, they're really thinking about the core food groups. They're thinking about office buildings. They're thinking about malls and shopping centers. They're thinking about apartment buildings. But just in the last 5 to 10 years, there's been a whole proliferation of new asset classes which have applied for the REIT designation. I think at first investors were somewhat skeptical about the nature of their businesses, but over time there's been greater adoption. So what we've seen is, companies that run massive data centers, right? We think about how important the Internet of Things is and how connected we all are, the exponential rise in data usage among individuals and businesses and appliances and everything. There are these companies that own massive warehouse-looking like properties that are very dense with air conditioning and cooling that are very operationally intensive but don't look like traditional real estate.
Right.
There are companies that own cell phone towers, not very sexy, right? All across the country. And so there are new business models that I think that real estate investors are just learning about. And particularly when it comes to obsolescence and anything that's technologically driven, the traditional real estate investor likes to just think about demand and supply and demand. What are the factors that could drive these things? But we're not as good in dealing with, power usage, density, and just the idea that a building 20 years versus 10 years, that there could be major obsolescence issues with it. I think it's some of these companies that operate on much shorter times, like life cycles,
right?
Where we've seen hiccups are when companies have had to kind of adapt and respond to their environment, and they've changed course. And I think the average real estate investor is still looking for something that's steady, that's going to pay out a dividend. And there's been times where I think the whole industry has been caught off guard about the changing landscape, especially the competitive landscape outside of just the supply and demand on the real estate side.
Do you think in this environment with COVID as being one of those unexpected risks that we'll see a lot of M&A or just mergers and acquisitions or consolidation in the industry?
Good question. We've definitely seen a lot of that in the last year or two prior to this event. I think, in this health crisis that we have, it's making people again think about how they use real estate, right? I think that the fungibility and the obsolescence factor becomes something that's worth discussing again. Now that everyone's working from home, I think the purpose of an office landlord, right, maybe is evolving. I think the nature of working from a remote location and the viability of that, I think, is being kind of rediscussed or kind of revisited among companies. I think, the nature of our advanced logistics system today and the need for high quality industrial locations to service the end user, I think, is even more important today. So I think in some ways the COVID-19 crisis will exacerbate or kind of hasten some of these trends that we've seen already through the last couple of years, and in other ways they add incremental uncertainty. If let's say for multifamily, the idea of urbanization has been a trend that we've seen this entire decade. People wanting to be closer and closer to the city, And that's fantastic for employers, for a lot of these young workers that go. But ultimately, if there are health issues with density and crowding, maybe there is a flight to the suburbs, right? If education policy and some of these other public policy factors influence where people want to live, then a lot of the times the real estate will have to follow that, so to speak. Even though I think the best companies want to get ahead, right? We saw companies get ahead of these trends.
Right.
Sometimes a health response or a kind of a public policy response will have these companies thinking about the other side.
Gotcha. So one of the last questions I have for you, Jimmy, I know we're going on time, so thank you very much. What would be the best piece of advice you can share with the audience?
This is probably something that many people smarter than myself have said before, but it is to stay invested in the market, right? That's the power of compounding returns. There's so many Americans that, for a whole bunch of reasons, are tight on cash, and young Americans that are dealing with student loans, that are dealing with the financial crisis from a generation ago, that don't have the resources. The time is on everyone's side, right? And for investors with long-term time horizons, putting $100, putting $1,000 in will make complete wonders to our investment portfolios in 20, 30, 40 years. So I just hope everyone stay invested, dollar cost average in, and think about the long term. Think about what 40, 50-year-old, 60-year-old you would want financially, right? So I think that tends to escape us in the moment, and certainly there are bigger concerns. But I think corporate America and just the strength of the consumer and the strength of American enterprise makes me perpetually optimistic. I came here to America as an immigrant largely for a lot of these reasons, and I see it every day. We're incredibly resilient. We're resourceful. We're creative. Sometimes we need to be checked a little bit, but we're very creative. And I really think that the best is, definitely yet to come.
I love it. I love it. I love the optimism. What's the best way for people to get in touch with you, Jimmy?
Yeah. So, the best way to get in touch with me, you can find me through email. I think, Adam, you can provide people with my email. I am on social media, although I think there are some restrictions as a finance employee on what I can say. But you guys can find me on Wang Theory, W-A-N-G Theory. And, I think you'll see me around on LinkedIn. You can also find me on LinkedIn.
Beautiful. Well, thank you so much, Jimmy, for coming on the show. It's been a real pleasure.
Yeah, Adam, thank you so much for inviting me in these crazy times.
My pleasure. I say shishay it to end it. That's the only thing
Yeah.
I know. All right. Talk to you soon. Take care.